Corporate Finance OneNote Practice Problem. In this presentation, we're going to continue on to part 2 of our practice problem in OneNote for a comprehensive ratio analysis problem where we have 2 sets of data, 2 companies, 2 income statements, 2 balance sheets, where we'll calculate the ratios for the 2 companies and then do some analysis of the ratios between them. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. Note that we're in the same tab as the prior presentation because we're going to be continuing on with the same practice problem. If you would like to follow along in OneNote, you're not required to, but if you have access to it and would like to, we are on the 347 Comprehensive Ratio 2 Companies tab under the Practice Problems section. Closing this back up, we're going to scroll on down. Notice we have what we're going to do is we're going to go through 2 data sets for 2 different companies, that being Company A, Company B, balance sheet, and income statement for the 2. Here are the 2 statements lined up at the top of the OneNote problem. We did Company A last time, meaning we're going to scroll down through Company A. All these data sets are breaking out just Companies A's data, where we went through the profitability ratios, and then the asset utilization ratios, and then we went through the liquidity ratios, and finally debt utilization ratios for Company A. Now we're going to do the same thing for Company B. We're going to put these side by side to what we came to on Company's A data. So we're just duplicating Company A's data. Then we're going to reveal Company B's data as we go. And then we can do some analysis between the 2 as we go through these calculations. So we have a similar layout as we had before, except now we've got our data set for Company B, that being the balance sheet, total assets and liabilities on it, then the income statement, the performance statement, bottom line, net income of the income statement. So we'll go to our profitability ratios, those being once again the profit margin, the return on assets, the return on equity that we will be calculating here. So we have the profit margin. I'll go through this a little bit more quickly because we spent a little bit more detail discussing exactly what they were last time. So we've got the net income divided by the sales. Those are going to be the bottom line of the income statement divided by the top line of the income statement. And so if we pick those up, we've got the net income divided by the sales number. That's going to give us our profit margin. If we were to calculate this out, just to practice making it a percent, 85,360 divided by the 1185000, that's going to give us, if we move the decimal over, about 2.20%. And remember, the top line of the income statement is here. It's always going to say credit sales because we pulled it from this item. Just remember that for this particular calculation, doesn't need to be credit sales. It's just sales, top line, revenue, income. Okay, so then we have the comparison between A and B. So A, notice that means that basically for every dollar of sales we have, we're holding on to about 6.31 cents of it. And B, every dollar of sales, we're holding on to about 7.2 cents of it, or for every $100 of sales for A, we're holding on to $6.31, or for every $100 of sales for B, we're holding on to about $7.20. So that means that B would be better here. We would like to have a higher profit margin if we can, but there's always going to be some trade-off typically between the profit margin and the sales volume, the amount of units that we're basically going to be selling. But in general, B would look better here between the 2. So then we're going to go to the return on assets. So return on assets, ROA, we're going to be comparing net income, income statement number, to a balance sheet number, which is going to be the total assets. This is looking at how well we're utilizing our assets, the things we have in the company, in order to generate the return, which is basically the net income after expenses, bottom line of the income statement. So we got the net income compared to total assets. Remember that you might see this as average total assets, given the fact that we have an income statement account and a balance sheet account. I won't mention that quite as much this time, but just recall every time you have that situation, then you'll have to look at the context of the problem you're looking at. So we've got the 85,360 divided by the 510,200. That's going to be about, if we move the decimal 2 places over, the 16.73%, about 16.73. These numbers we would like to be higher, so that means that B is looking better for this number as well. Notice that the net income is somewhat similar for these two companies, but the total assets, B has less in terms of the total assets. So what does that mean? That means that B is generating net income that's comparable to A, and they're doing that with less assets in order to do it. They have less stuff, less things that they're able to generate a comparable return to. Therefore, they're using their assets more efficiently. So remember, our goal isn't really just to compile assets up to have a bunch of assets. The goal is to say, hey, do we have the assets that we need so that we can achieve the goals that we have? If we can achieve a good rate of return with less assets, then that might be a good thing. But we want to consider other things in terms of risk in the future and that kind of thing. But in general, that would be the case. B, then better here. Then we got the return on equity, which means we're going to be comparing the net income, so income statement number, to the equity section. So here's the equity section of the balance sheet. So if we compare that out, we're going to say the net income compared to the equity section of the balance sheet for B. Now remember, the equity section of the balance sheet can be represented as, well, if we think about the accounting equation, assets equal liabilities plus equity. Equity represents the owner's kind of portion or claim to the assets of the company. It could also be written as assets minus liabilities equals equity. So therefore, equity is like the book value of the company or the claim of the owners of the company. Kind of what's at risk in essence of the owner, what the owner has on the line for it. So we want the return, what we're getting with regards to equity, to be high once again. So we'd like net income to be high. Notice the net income is comparable, and then the stockholders' equity is a lot lower for B. So if we were to do this calculation, we would be saying 85,360 divided by 179,500, moving the decimal 2 places over, about 47.55 about percent. 47.55 about percent. So it looks like we're getting a lot bigger return on equity for B. Now you have to be a little careful with equity, however, or this calculation when you're comparing different companies, because the amount of leverage in the company can distort this as well. So you look at this, you're going, wow, B's doing a lot better with regards to the return on equity, the amount or the book value of the company. But you also want to consider when you do this calculation, notice that, when you think about the equity number, are they doing the same amount with less stuff, or are they more leveraged? So one way to have the same amount of assets while decreasing equity is to be more leveraged, meaning have more debt involved. So you want to consider the debt levels when you're thinking about this calculation as well, to see how leveraged they are, how much debt they have as compared to their assets, which we'll take a look at later, which could have an impact on this calculation. Okay, then we have the asset utilization ratios, including the turnover ratios, including accounts receivable turnover. We'll take a look at the average collection period, how many days outstanding the receivables are on average, inventory turnover, fixed asset turnover, and then the total asset turnover, which kind of encompasses the other turnovers. All right, so we're going to start up top with the accounts receivable turnover, which is going to be sales divided by accounts receivable. These will all have basically a balance sheet account and an income statement account. Balance sheet being, or the income statement being sales, top line of the income statement, performance number, and then balance sheet in this case being the accounts receivable number. Now note that anytime that's the case, then you might see this as average accounts receivable on the bottom here, depending on the context of the calculation where you are working that, or who you are working it for, or what it's being done with. So also note that the sales, this is when that credit sales is applicable, meaning these are all sales. All the sales were on credit. We sold them on account. They went through accounts receivable. They weren't cash sales. If they were cash sales, we might have to calculate out the portion of the sales that were credit sales, in this case, to think about the turnover for receivables. Then we're going to be taking the 1185000 divided by the 82800, and that's going to be the 14.31. All these turns, we would like them to be higher, so the higher the better. That means that we're turning over our receivables faster, meaning if we turn over the receivables faster, we're holding on to them a receivable less and getting the cash sooner, improving the cash flow, lowering the likelihood that we're not going to be able to collect on the receivables at all. So obviously we want the sales to be higher, and the and the accounts receivable, if we can have the same sales volume and lower receivables, that means that we're turning over the receivables, collecting on them sooner. So that would be good. So B is looking better here at the 14.31 compared to A at the 7.28. So then we got the average collection period, breaking down this turnover, which can be kind of abstract, but you can see how much easier it is to look at in context to some other, comparing it to a benchmark company, another company, or to industry standards, or to prior performance. But it's nice to break it out to the days outstanding, which one way you can do that is you can take the days in a year, which may be 365, or you might try to standardize the days, standardize the months, which would be 12 times 30, approximating 30 days in every month, which would be 360. Dividing that by the 14.31 we calculated up top for the receivable turnover, and that would give you the days approximately outstanding. 360 divided by 14.31, about 25.1516. Notice there's always rounding that's going to be involved here. So just depends on how far out you're rounding the numbers to. You might come to some slightly different calculation. Again, in practice, that's okay because you're looking for the number that's going to give you relevant data. They're all estimates. In a book problem or test question, you want to be careful with the rounding so you get the exact rounded to number that they're looking for. So this number we would actually like to have lower. And so B's looking better here because the average receivable is outstanding by 25.15. And obviously, if this number is higher for B, which is better, you would expect the days outstanding then to be lower in this case. So it looks like A, you're saying, hey, your receivables are average outstanding almost 50 days. We'd like to get that down if possible. With B, you're saying, they're 25 days. That's pretty good. If we can get it, if we keep doing a good job, if we can get it lower than that, that would be good. And that's typical company receivable for many companies might be like 30 days, but it depends on the industry. And if you can, some might be longer, some shorter. If you can lower the days, no matter where you stand, better off you are typically. You can also do this calculation, same calculation, get into that same bottom line number, days of receivable outstanding on average, by taking the receivables and dividing them by the sales per day, which can be calculated as the sales. If we take the sales number top line, assuming these are all credit sales, divided by the number of days, 360. You could put 365 here. 360 is estimating 12 months at an average of 30 days. That would give us then the 1185000 divided by the 360, or about average sales per day, 3,292. And then if we took our 82800 divided by 3292, we get the 25.15 days, same as we got up top. All right, so next item, the inventory turnover. Now, when you think about the inventory turnover, top item might be cost of goods sold, might be sales. Depends on the context that you're working with. We're going to be using sales here, but just remember it could be either of these two. We talked about the reasoning on why you might use one or the other in a prior presentation. So we're going to be using then the sales number. We're going to be dividing that by the inventory number. So inventory over here, notice you're comparing balance sheet item, inventory sales item, and also note that the sales don't necessarily need to be credit sales at this point, that we're just picking that up from the top line of the sales number here. Therefore, you might see this calculated as net sales divided by average inventory, most common average being beginning of the period divided by end of period, or beginning of the period plus end of the period divided by 2. So just be aware of that. 1185000 divided by 76800. So that's 15.43. Once again, we would like these to be higher because that would mean that we're turning over the inventory more. So if you look at the sales items, A's actually got more sales. We would like sales to be higher, right? And then the inventory, A has less inventory, which would indicate that they're turning over the inventory faster, holding on to less inventory at any given time, whereas B's got the higher inventory on the books, resulting in a lower turnover for B than A. So here it looks like A has a better turnover for inventory. So then we can look at the fixed asset turnover. Once again, taking sales, doesn't need to be credit sales. That just happens to be the wording that's on the sales line, but sales or net sales. And then we're going to divide that by the long-term assets, which could also be called depreciable assets, could also be called fixed assets, long-term assets, PP&E, property, plants, and equipment, right? We're going to take the things that are like building and equipment and whatnot. So we're going to be picking that up. One's going to be a balance sheet number. One's an income statement number. Income statement sales. Balance sheet number is going to be the long-term assets over here. And then if we divide them out, we got the 11885,000 divided by the 2924. That's going to give us the 4.05 about. This is a measure of how efficiently we're utilizing our property, plants, and equipment, our depreciable assets, our fixed assets. And so the higher the number, the better, because we want to be turning them over faster. We want the sales to be higher, and if we can have sales higher or the same with less investments in long-term assets, that would be good. So notice that A has more sales, but they also have more of the long-term assets. B's got less sales, but they also have a pretty substantial less long-term assets. So B is getting a higher return with regards to those fixed assets. And that means if we can have less in fixed assets, note that we're locking down less stuff, because fixed assets, we can't pay off our current liabilities with fixed assets. It's less liquid of assets than, say, cash or other assets we could have. Okay, so then we have the total asset turnover, which is going to be the total kind of encompassing all the turnovers. So we've got the 510, 200 on the balance sheet item, and then the sales item at the 1,185,000. Once again, we're comparing an income statement item, balance sheet item. Therefore, you might see this calculated as net sales divided by average assets, which most common average beginning of the period plus the end of the period divided by 2. So if we calculate this out, 1185000 divided by the 510, 200, we got about 2.32. So 2.32, this is a measure of how effectively we're using total assets. Once again, we would like to have this number higher. The higher, the better. So B looks better here with the higher number here. And so the sales, once again, A's got higher on the sales. We would like the sales to be high. But notice that B is getting that sales number with less total assets. So their sales are higher with less assets. They're using less assets in order to generate somewhat comparable sales number. So B would look better here. Notice once you do this comparison between the two, you're going to say, okay, B's better here. And then you can kind of think about this as the overarching comparison and then break down, the components of it, going back up and saying, well, yeah, B's better on the fixed asset turnover, the inventory turnover. A's actually better on the inventory turnover here, and then B is better on the receivable turnover. So you can kind of break those down a bit in that category. Next, we have the liquidity ratio. So liquidity ratios, including the current ratio and the quick ratio. So these are assessing the liquidity, how likely they'll be able to pay off their current liabilities in essence. So the current ratios, one of the most common ratios you kind of want to know, there's going to be like a standard ratio that one of the first ratios people learn. Bankers would want to know, the ratio, and so would companies in order to see if they can pay off their current liabilities. That's going to be one of the most urgent things that need to be done, so that therefore there's focusing on this ratio. So the current assets are going to be on the balance sheet. So current assets, including cash, marketable securities, accounts receivable, and inventory in this case, as compared to the current liabilities, which are those that are going to be due within a year, and therefore they're somewhat urgent. We want to make sure that we can pay those off within that time period. The current assets represent assets that are going to be more liquid, things that we're going to consume shortly, or that are more convertible to cash, or closer to cash in nature. So then we're going to be taking our 217,800 divided by the 82700, and we're going to get that 2.63 about. So that means that we can pay off our current liabilities 2.63 times over with the current assets. So that's good. Well, you want this thing to be over 1 for sure, no matter what the industry typically. Otherwise, looks like you're in danger of not being able to pay off your current assets. And then the higher this would be, the better for like a banking standpoint to feel more secure about giving you a loan or something like that. But then you want to compare it to industry standards and so on. Now you could restrict this further down by saying, okay, let's remove the inventory from the numerator and say not current assets but quick assets, and then we can say, well, what if there's a downtime and they can't sell inventory, could they still pay off their debt? Just to check it out. And we could say, well, let's take the quick assets then, which would be calculated as, you can do it a couple different ways. One, calculating cash, 45,000 plus the marketable securities, 13,200 plus the accounts receivable, 82,800 for the 141. Or you could take the total current assets of the 217,800 minus the inventory, the 76,800. That would give you that 414. Comparing that then to the same current liabilities we saw before, reducing the numerator, keeping the denominator the same, divided by the 82700. So now we can pay off the current liabilities using just the quick assets, not including inventory, 1.7 times. So again, you want this to be over 1, but notice it's a little bit less than company A here because it's more of their current assets are related to the inventory, which could be a little bit more concerning. Again, you want this to be over 1. If you were to compare the two, then the banker would feel more safe giving a loan possibly to A, given these two ratios. These two are pretty close, obviously. This one's a little more spread out. So that would be leaning towards A for at least from a loaning perspective. Now we're going to look at the debt utilization ratios, including the debt to total assets and the times interest earned. So debt to total assets is exactly what it sounds like. We're going to take the liabilities, which is the debt. So that's going to be total liabilities. Let's just reveal it here. Total liabilities compared to the total assets. Total assets, these are two balance sheet numbers. Remember what we're comparing here. Assets is what the company has. Liabilities and equity represent who has claim, either third-party liability or equity. So you're comparing and contrasting of what the company has, of what two categories have claim to it, right? Liabilities or the owner's equity. So therefore, if we calculate this out, we're going to say, all right, that means that we got liabilities of the 330,700 divided by the 510,200. So moving the decimal over, that's 64.82% about on the liability side. And if I then subtract that minus 1, that means equities allocated the assets of 35.18. Now this looks a little bit concerning here because that's a bit higher. That's substantially higher than A. Now, and again, there's a debate on whether or not you should have how much liabilities you can have, because note that a lot of the performance numbers we've looked at B, it looks like they're getting a rate of a return on their assets and whatnot. So if you were to look at the accounting equation, assets equal liabilities plus equity, and you're saying, hey, we're still getting a return on assets. I would like to have more assets because I think we can get a return. We can increase the net income on it based on our numbers. Then, there's two ways you can generally increase the assets. You can generate revenue, but that can take some time. You can have the owner put money in, but that means the owner puts their money directly on the line there, or you can take out a loan. So, and that would be leveraging the company. So some would argue to some extent leverage would be good up into some extent because you can take the loan out, you can increase your assets. If you're getting a return on investments that's greater than the interest that you're paying on the loan, then you'd be doing well. You'd be increasing. However, if you get the liabilities too high, and there's debate as to how much is too high, then you're obviously, the higher the liabilities, the more at risk you are of problem happening. So if there's a downturn in the market and you're over leveraged, then meaning you have a lot of liabilities as compared to your assets, then and you're not making any income anymore, right? Because now the economy went down and you're not able to get a return on the assets, and you're still paying off the interest on the debt because the debt is still out there. Then you're more at risk at that point in time. And of course, you might need a loan at that point in time, and it would be difficult to get a loan at that point in time because you'd already be leveraged. So it'd be hard to get a loan past that point. So 64% being at the liability side compared to the 35 would be, seems high, and it's definitely high with comparison to A. And from a banking standpoint, then if the bank was to give a loan, then obviously they would like the 28.5% here, more likely to give a loan to A based on this information. And note this leverage also you have to take that into consideration when calculating some of these performance measures. I'm going to scroll up top, including if we go to the performance measure for this item, the return on equity. So remember, we calculated the return on equity, and we're like, oh, if we take the assets minus the liabilities and compare that to the net income, B is looking a whole lot better there. But when we look at that number, we got to remember that they're also very leveraged. So that means that their equity as compared to their liabilities is a lower proportion of their liabilities. So if you look at B's performance, they're getting a rate of return on their assets, their total assets, which is good. Their performance is looking good, and their profit margin is okay. But then there could be maybe concern when you compare the two about, of course, the debt to total assets. Okay, so then let's take a look. Well, what about the interest earned? The interest earned means how many times over could you pay the interest? So that calculation is going to be the net income before interest and taxes compared to the interest. That's going to be a performance statement. So we're taking the net income, and we want to think about how much we're earning and how many times over we could pay the interest. So that means we want to take the net income and back out the interest because it's already included in net income. And we're going to back out taxes because interest has an effect on the tax calculation, and taxes just muddy the water in general. So we're going to back those out. When we do, we're going to get up to the operating profit here. But it's useful to understand that it may not always be operating profit. It just happens to be so in this case due to the multi-step income statement that we have. So we're going to have the 85,360 plus the taxes of the 69,840, adding those back in, adding the interest back in of the 31,000, and that's going to give us the 186,200, which is equal to the operating profit in this particular statement. And then we're going to compare that to the interest, which is 31,000 that we're paying. So that's 186,200 divided by 31,000. Means we can pay over the interest about 6.01%, about 6.01 times, not percent, 601 times. And so that means we can pay it over 601 times. So you would want this number to be higher. So as the higher the better in terms of a bank loaning you more money, they would be more secure. So A would look better with regards to that. So there's a quick breakdown. Obviously, when you look at these numbers, this is one thing you would do, maybe benchmarking to another company if you wanted to compare and contrast the two companies. If you're like a manager comparing and contrasting to some other company that you're trying to benchmark to, trying to compare to, and you'd want to compare basically to the industry standards that you could. You'd want to compare to your past performance to look at the trend analysis on these ratios. What are the differences that are happening? And then when you compare it to industry standards, you'd want to compare these two, where you stand or where the ratio is at that point in time, and the trend analysis that is going on from comparing your past performance to the trend analysis past performance of the industry.